Amazon is worth over $2 trillion today. But rewind to the end of 2001, and Wall Street had basically already written its obituary. Between December 1999 and April 2001, Amazon stock dropped from just over $106 a share to $8.37. That's a 92% collapse. Analysts were openly predicting bankruptcy. A major Wall Street report said the company would run out of cash within a year. Amazon didn't just survive. It became one of the most valuable companies on Earth. Here's how a company that Wall Street had left for dead pulled off one of the greatest turnarounds in business history, and what almost killed it in the first place.
Amazon went public in 1997 as an online bookstore. From day one, Jeff Bezos ran the company on a philosophy that made Wall Street nervous: lose money on purpose, plow every dollar back into growth, and worry about profit later. For a while, investors bought into it completely. This was the middle of the dot-com boom, a period where any company with .com in its name could raise huge amounts of money on the promise of future growth, whether or not it made a cent in profit. But not everyone was convinced. In May 1999, Barron's ran a cover story on Amazon that became infamous. The headline was blunt, and the argument was simple. Amazon wasn't really doing anything a traditional retailer couldn't do eventually. It was burning cash at an alarming rate, and sooner or later, the market would stop rewarding growth without profit. At the time, most people brushed it off. In hindsight, it was an early warning sign of exactly what was coming.
In March 2000, the dot-com bubble popped. The Nasdaq started a long, brutal slide, and internet stocks got hit hardest of all. Amazon stock, which had already been sliding since December 1999, went into freefall. Then, in June 2000, it got worse. A Lehman Brothers analyst named Ravi Surya published a report arguing Amazon could run out of cash within 4 quarters. The report was aggressive, and it worked. Amazon stock dropped another 20% almost overnight. Here's the thing: the report turned out to be wrong. Amazon actually had close to $1 billion in cash and securities at the time. But that almost didn't matter. When a credible analyst says a company might run out of money, it can become a self-fulfilling prophecy. Customers get nervous, suppliers demand faster payment, and the stock spirals further, making it even harder to raise money if you actually do need it. By early 2001, Amazon's stock had fallen over 90% from its highs. Jeff Bezos opened his year 2000 shareholder letter with a single word: ouch. And yet, and this is the part that gets left out of the doom narrative, the actual business was still growing. Sales went from $1.64 billion in 1999 to $2.76 billion in 2000. Customer accounts grew from 14 million to 20 million. The stock price and the business itself had become two completely different stories.
This is the part worth studying, because Amazon didn't get lucky. It made a series of deliberate moves that most struggling companies don't make in time. Move 1: they raised cash before they needed it, not after. In February 2000, right as the market was starting to turn, but before the worst of the crash, Amazon sold $672 million in convertible bonds to European investors. It wasn't a desperate move. It was a cushion built while the building was still standing. Bezos later said plainly, because of that raise, Amazon never had to go back to the capital markets during the worst of the crash. That timing is arguably the single most important decision in this entire story. Move 2: they cut costs hard and fast. On January 30, 2001, Amazon announced layoffs and consolidated its fulfillment and customer service operations. This wasn't a symbolic gesture, it was a real structural change to the cost base of the business, at a moment when a lot of companies were still in denial. Move 3: they gave themselves a public deadline. Bezos set an explicit target: Amazon would reach profitability by the 4th quarter of 2001. Publicly committing to a specific number, on a specific timeline, forced discipline throughout the entire company. There was no room to quietly slip the deadline. Move 4: they kept growing anyway. Even in the middle of the crisis, Amazon didn't retreat into just being a bookstore. It expanded into electronics, tools, and kitchen goods, grew international sales, and by Q1 2001, net sales were still up 22% year-over-year to $700 million. They cut costs without cutting off the future.
In January 2002, Amazon announced its first ever profitable quarter. Net income for Q4 2001, $5 million. On a company that size, that's barely a rounding error, about a penny a share. But symbolically, it was massive. Every skeptic who said the model was broken, every analyst who predicted bankruptcy, every Amazon.bomb headline, all of it was answered by one modest, unglamorous number: proof the business worked. By that point, Amazon stock had lost so much value that its entire market cap had dropped to around $2.9 billion. Anyone who bought in near the bottom, when the headlines were the most terrifying, would go on to see one of the greatest returns in stock market history. A few things worth pulling out of this. Stock price and business health are not the same thing. Amazon stock fell over 90% while its revenue nearly doubled. If you only watched the chart, you'd have missed the entire real story. Raise money when you can, not when you're desperate. The $672 million raised months before the crash is arguably the reason Amazon had options at all during the worst of it. A public, specific deadline creates discipline that vague optimism never will. And maybe the biggest one, surviving a crisis and denying there's a crisis are two different things. Amazon didn't pretend everything was fine. They cut real costs in public while still investing in the future.
If you want more breakdowns like this, companies that nearly died and the exact decisions that saved them, subscribe, because this is going to be a series. And let me know in the comments, which company do you think is under that kind of pressure right now?